Hi everyone, we're here today to talk about retirement savings advice. Do you know really how much you need for retirement? Let's just delve into this topic. It's so important. But each one of us, we have different things that we want in life, right? But at the end of the day, all of us just want to make sure that we are able to retire comfortably. I'm Steven, I'm a financial coach with Naluri and a licensed financial planner as well. So here we are today to look at how your goals and how your wellness is all interlinked together, including your financial wellness leading right up to your retirement or your golden years. This will be some of the agenda that we'll be looking to cover today. Firstly, we will look to understand your retirement needs. Second, to really define and know what those needs are. Number 3, what's your retirement number that you need to be looking at? Fourthly, how does retirement savings, investing, and all of this come together to form your personalized retirement plan? And last but not least, to work with a financial coach or a financial planner to come up with your personalized retirement plan. Hopefully, by the end of today's session, we will achieve all these 4 learning objectives. Firstly, learn how to plan for your own successful retirement planning. Second, have a strategy really on how to actually reach your retirement needs. Thirdly, to understand that there are risks at play when you do not actually plan out your retirement. And last but not least, to look at retirement savings and investment techniques and how it all comes together. First, let's start by looking at what are some of the challenges that we look at retirement. Now, retirement may mean different things to different folks. For example, for someone who is in the early 20s or maybe even the early 30s, retirement might seem to be this thing that's just so far away, right? Retirement? Why do I even need to plan for it? I have, decades, years and many years ahead. And you're not wrong. In fact, retirement used to be a very new concept actually in our society. In the past, retirement was something that didn't exist because, hey, everyone just worked until they couldn't, right? But you can actually look at it or define it in different ways as well. Perhaps you might want to call it financial freedom or financial independence. Basically looking at how you actually reach your golden years to make sure that what you're doing today is also planning for your future self as well. Now, one key statistic is the majority of retirees regret not starting earlier. And this is due to the fact that the more that you have time on your side, the easier it is to actually hit your retirement goals. And almost a quarter of people around the entire world, our entire globe, are actually worried that their living standards would start dropping after retirement. And that's not very nice to go through, right? For example, if you're already happy at a certain comfortable level of living, and suddenly it feels like, hey, you have to live life a little bit less once you hit retirement. Hey, but the good thing is that there are things that you can actually do to help you to reach your retirement that you desire. So one other key trend that we're seeing as well is that due to better healthcare, all of us are generally living longer as well. The average life expectancy for a female is 76 and for a male is 71. But you may want to be more conservative as well when it comes to your life expectancy, or what some would call as a longevity risk. For example, if your great-grandparents, your ancestors, everyone lives past the age of 100, hey, you might want to plan to be a little bit more conservative as well. But generally, we would suggest to look at the age of 85 as a good age to target when it comes to life expectancy. Now, are you ready for retirement? So as a case study, we'll talk about Malaysia for today as well. And Malaysia has its own pension fund as well, known as the Employees Provident Fund, or EPF in short. And the CSO, Chief Strategic Officer of EPF, has actually come out to say that someone today that will be retiring in, say, 20 to 30 years from today would at least need between 900,000 to 1 million actually to retire. But when you look at the minimum basic savings that Malaysians should have, you're only looking at having 600,000, which, according to EPF statistics, only 4% of Malaysians can actually afford to retire. In fact, the majority of Malaysians in their pension funds have less than 10,000 ringgit in their accounts, while slightly more than a quarter have less than even 1,000 ringgit, which, as you can definitely see, will not last long during your retirement years. So, how do we get started as we look into this? It all starts by really knowing what's the life you live today and what's the life you want to be living when you reach your financial independence or your retirement age itself. So key things or key questions that you need to be asking yourself: how much do you need per month or per year? So a myth is that, hey, when you retire, that your expenses will drop tremendously. That's not quite true. On average, yes, expenses does drop a little bit. For example, you may not need to get new clothes, you may be driving a little bit less as you don't need to commute daily for work. But a lot of expenses are still there. You still have bills to pay, you may be eating out even a little bit more. So a good gauge is that based on what your spending is, you should estimate that your expenses may drop about 20%, which means you need to be having at least 80% of your current expenses. Now you need to factor that in. How much is that on a monthly basis? How much is that on an annual basis? And remember, we talked about life expectancy as well. For example, if you decide to retire at the age of 60 and you're looking at a life expectancy of till age 85, you are still looking at another 25 years. So a lot of people don't realize how long this period of retirement can be. Hey, it can be up to a quarter of your life still that you actually need this income to sustain all your living and your expenses. And there are other factors to consider as well. Firstly, will be the effect of inflation. So inflation does vary from country to country, but generally in Asia, we're looking at inflation anywhere from 3 to 5% rate. And certain inflation can run even higher as well. For example, this year we saw that food inflation, food eating out, groceries, that rose at a very much higher rate than the overall inflation rate. Other things you need to be considering as well will be what is actually going to fund your post-retirement. Do you have enough set aside between your pension funds, your savings, your other investments? Do you have rental income coming in? Do you have any other sources of income coming in as well? So those are all things to consider. And we haven't even talked about effects of things like medical coverage, because as we get older as well, the risk of requiring medical care does increase with age as well. So that is another risk to consider. So this is just an example of how much you would actually need. So in this case study, assuming that you need 60,000, which works out to be about 5,000 a month, and your investment returns, if you can generate, say, on average 5% on your entire portfolio, which should be very doable for most folks with a proper investment asset allocation. And then you're looking at inflation. So let's just say we use a very conservative inflation rate of 3%. This means that what you actually need to do is to calculate between what your investment returns are and actually making those adjustments on the inflation that you're having. So your actual returns will only be 1.94%. And if you assume from 60 to 85, that 25 years that we're talking about, you would need at least 1.2 million in order to fund your retirement. And this is assuming that your retirement funds would actually go down by time until you reach zero. But if, for example, you want to live purely off the dividends and the returns of your investment without touching the capital, then you'll be looking at a much higher amount as well. So let's delve right into it. What's your retirement number that you need to be looking at? So what is really helpful for most people is just to, hey, pull out spreadsheet, key in your current age, key in the numbers for your expenses, and then you're able to see and visualize what will be the effects of inflation and how it would actually reduce. Charts can be helpful as well to see what is the number that you need to reach, say at the age of 60 or 55 or 65, whatever age you desire to retire, and based on your life expectancy. So at the very least, your graph should look like that your funds are able to sustain you until the age of 85 or whatever the age of your longevity that you're targeting. And I know for those who may not be maestros at spreadsheets, there are a lot of free calculators and charts available out there. So for example, there's a free resource available and there's a QR code that you can access as well, where you can just key in your current age, your retirement age, your life expectancy, what are your current expenses, how much you have currently set aside for retirement, what's your current income, and the investment rate and inflation rate. Don't worry, the fields are automatically pre-populated for you, but you can feel free to adjust those numbers, and you just need to hit the calculate button. And with that, you will actually know, hey, what is your actual retirement number that you need? Where are you right now based on what you have set aside for savings investment? What is the gap that you actually need to cover in these years ahead? And then suddenly it gets a lot more real for you once you can actually see the numbers and where you are today and where you need to be heading to. So there is a saying that compounding is the eighth wonder of the world, and saving early really does make a difference. So you should be targeting to save at least 10 to 15% of your income. And this is on top of whatever you're contributing, for example, towards a pension fund or provident fund. Ideally, if you can do 20%, and there are folks who actually set aside 40% of their take home income as well. But it does get more challenging when you are actually starting much later and much nearer towards your age that you desire to retire. But with that being said, there is another saying as well. The best time to start investing is 10 years ago. The next best time really is today. So it's never really too late to get started. In fact, statistics show that if you have at least 10 years ahead before your retirement age, you, with a little bit of discipline and a little bit of structure, will be actually able to head towards your retirement goals. Step 2 is to identify what you currently have, and as we were talking of earlier, comparing with what we actually need in order to fund your retirement or your financial independence needs. So you'll be looking at your savings, your EPF, provident funds, pension funds, any unit trust that you have, shares, property, and other assets as well. So other assets may also include things like gold or silver, precious metals, cryptocurrencies, NFTs. So all of this will be assets that you would want to be looking at when it comes to what makes up your funds that you have for your retirement. So this is just a continued example of a retirement fund calculation. So you want to see what is the actual expected returns from each investment that you have. Generally, certain investments that are lower risk and more conservative in nature will generally give lower returns. But the advantage of that is that it is less volatile, and when there's a market downturn such as the one that we're in currently, you would see that the impact of that on your investments is minimized. On the other end of the spectrum will be higher risk investments, so you might be looking at historically generating 8%, 10% or more returns per year. But there's always a flip side to that, in that you would definitely be looking at generally higher volatility up and down or higher swings when it comes to those investments. Next, you're going to be factoring in how many years from today until your desired retirement age, and how much are you currently setting aside into all these different investments. What adjustments that do you need to make? Generally, all of this can be grouped into 5 different investment asset allocations. The first will be cash and cash equivalents. Secondly, will be fixed income. So this will be things like bonds, bond funds. Third will be equities, whether you directly invest into the stock market or use exchange traded funds or unit trusts to get access to the market. Fourth will be property, whether you're investing into physical property, whether it's residential property, commercial property, land, or using a vehicle such as REITs, real estate investment trusts, to get access to property. And last but not least will be alternative investments. So this will be assets such as gold, silver, cryptocurrency, peer-to-peer lending, equity crowdfunding. All of this will fall under alternatives. So no matter what age you are, you would want to have that right balance between all these 5 different asset classes. Generally, the fixed income and the equities would be the larger portion of your portfolio. Even as you get older and you are nearer towards your retirement age, you still want to have a little bit of equity exposure, a little bit of fixed income exposure to just drive forward your returns and also give regular dividend returns to you. And then you can round it off by having a little bit of exposure into property, alternatives, as well as holding a little bit of cash for liquid spending as well. A general rule of thumb is that if you still have some years before you reach your retirement, you can hold about 6 to 12 months of your expenses for your retirement liquidity fund. But the moment that you are actually very close towards reaching your retirement years or in retirement itself, you will want to increase the amount of liquid funds that you hold. So generally, you would want to be holding between 2 to 4 years. So we're talking about between 24 to 48 months of expenses in liquid funds, such as in a savings account or in a money market fund, something that you have quick access that is actually liquid. And the reason for that is you want to avoid the situation where suddenly there's a market downturn or a correction and you're forced to sell your investments to cover or pay for your living expenses. So by having these liquid funds, you can actually ride through any volatility, any downturns there are in the market, and make sure that you have enough funds to suffice for this period of time. Step 3, you will want to see what are the strategies that you need to take in order to cover that gap from where you are today to where you need to be. So key things that you want to be looking at. Firstly, what is the amount that you have invested so far? What is the future amount of investment that you're setting aside? How many years will it be towards retirement? And nowadays as well, there's a growing movement talking about FIRE, financial independent, retire early. So for some people, this may mean different things. It may mean that you opt for some form of semi-retirement at an earlier age as well. And then maybe you're working just to cover your expenses. Or it might mean that you have your investments reaching such a size that you can fully retire and not work if you don't desire to, and with your investments be able to cover all your expenses. How this works though is it really does depend on where your investments are placed, what's the overall rate of return of your overall investments as well. Generally, you'll be looking at an approximate number of 25 times your annual expenses. So if your annual expenses is 100,000, you will be actually looking at 2.5 million as the number that you actually need to have. Lastly, you'll be looking at reducing fees as well as cost of investment, because all these fees are actually having an effect on your overall returns as well. So you would want to keep costs as low as possible, reduce the amount of fees that you pay, really look at each investment that you pay. Are the fees that you're paying, is it adding value to your investments? Is it giving you an edge or an alpha? If not, you might be better off looking at lower cost alternatives when it comes to your investments. Next, let's head into the part where we actually look at actual techniques when it comes to looking at retirement savings and investing itself. So, each one of us, we're all uniquely made. We all have different backgrounds. We grew up in different households, and we have different goals as well, naturally. So for some financial goals that we're looking at, maybe perhaps you want to get that new sports car, or you want to buy that dream home that you always wanted, or perhaps you want to send your own children to college, or hey, maybe you want to pursue a master's or a PhD, or you may be traveling the world, long-term healthcare, giving money to others, charity organizations, or maybe starting a business. All of this can be different goals, and really recognizing where and when you actually need these funds for all these goals. Because you need to be very clear that the funds that you set aside for different goals needs to be clearly demarcated and marked off. So you're able to set that aside for, say, your children's education fund, while at the same time making sure that you have enough for your retirement and financial independence. So what many of us, when we look at investments, we're always chasing after returns or investment or ROI. And it's like a never-ending game, isn't it? We keep chasing where the highest returns are. But we know that by right, what we should actually do is buy low and sell high. So if you're actually chasing higher returns, quite often what happens is that there's an investment that has already gone up so much, and you're buying in quite close to the peak, and then it starts coming down, and human behavior, so human psychology, start panicking, and then we sell as it crashes down. So instead of buying low and selling high, we do totally the opposite of that when we buy high and sell low. Now, some of you, or some people out there, may be wizards when it comes to investing, and you get the absolute perfect timing of when to actually invest. And hey, if you can do that, and just as a statistic, professional investors probably get it right about 50% of the time, which also means they get it wrong about 50% of the time as well. But if you manage to time your investments perfectly, then yes, you can achieve the highest potential returns. But for most of us mere mortals, what actually works better is to actually just save regularly. So when we actually save regularly, what happens is that you dollar cost average in when it comes to your investments. This means you don't buy at an absolute high, neither do you buy when it's at an absolute low, but you actually get to write what actually happens in the market, and you tend to buy in at a lower market price than average and avoid making mistakes as well. And studies have shown that the returns when you regularly invest in and use dollar cost averaging are actually very close to what you get if you actually perfectly time the market. And the truth is that investment markets tend to move very quickly, while at other times it actually remains very stagnant for very long as well. So no one is able to predict with 100% accuracy what happens in the future. So what one needs to do is just get in there, regularly invest, look at where's the proper asset allocation from your investments into the 5 asset classes that we talked earlier, within cash, fixed income, equities, property, alternative investments, re-optimize these investments over time, and rebalance as well. So rebalancing is when certain investments become too large, or too little. So what you do is you can actually take profit or dispose of some of those investments and invest where and in what asset classes is actually attractive. So by doing that, you get actual positive returns of an additional 1 to 3% a year, which doesn't seem much. But imagine if you have that 1 to 3% each additionally every year and you compound it over a period of time. Hey, that makes a very big difference at the end of the day for what actually goes into your retirement pool. Next, let's go into effective cash flow management. At the end of the day, the key things that we want to look at on what actually has a positive impact on your cash flow is really by increasing income, reducing expenses and costs, and basically how do you use this positive cash flow that you generate to generate returns for yourself. So increasing income can come in different ways and forms. For example, if you find, hey, Stephen, we talked about setting aside 15-20% of your income, but right now I can only set aside maybe 5% of my income. Then what you should be doing is a few ways. One is that you may be looking to increase your income. For example, you might look at where you can add value in your career, in your organization that you're at, get promotions, or look at side hustles that can actually increase the income that you have. On the other side, we'll be looking at reducing expenses. Are there certain things that are stressing you out? For example, are you looking at retail therapy as an expensive way to get immediate gratification? There may be places where you are overspending and you may need to control your expenses a little bit as well. And all of this combined together basically helps you to have better cash flow management, which means you can set aside more funds towards achieving and saving for future you. Another key portion to talk about, so we talked about investing, about growing funds. Another area as well is talk about protection. So to make sure that we get the amount of coverage that we need. Because overall in the world, we see actually hospitalization, medical costs increasing. And while normal inflation is probably about 3 to 5% per year, when we talk about medical inflation, you're actually looking at above 10% every year. So what that means is, let's say that there was a medical emergency or medical procedure that you needed to go through, and today it costs you 100,000. In 5.5 years, that would actually double, and you'll need to pay 200,000 for the same procedure. And in another 5.5 years, that would actually double to 400,000. And having a sudden large expense can suddenly put a serious dent when it comes to your finances. So, one way to look at that is what sort of protection that you have. Are you overpaying for your insurance? Are you undercovered? Or in a worst case scenario, are you both overpaying and undercovered as well? Are there options to get coverage at a lower cost? Is the policy that you're getting suited for your needs? And another thing as well is that you should be keeping your investments and your insurance separate, because generally insurance have higher costs when it comes to its function, and the purpose mainly is actually focused on protection. While if you know what investment options are out there, you may be able to get better returns at lower costs and fees as well. So, in short, to keep your insurance and your investments separate. So, having a full review of your insurance, what policies you hold, what gaps there are there ways for optimization both for you and any dependents that you have, for example, your children or your spouse, may be a good way to actually improve your overall coverage while reducing costs as well. Another key area to look at will be what is the tax relief that you can actually get. So, this is not talking about tax evasion, but it's about legally taking advantage of all tax relief that are available to you. So, for example, this is some of the tax relief that's available in Malaysia. So, for example, contribution to life insurance, you get up to 3,000 a year. Contribution to EPF, 4,000 a year. And even if you're self-employed, you can actually make voluntary contributions to EPF. There's private retirement schemes, which you also get a tax relief of 3,000 a year. And insurance premiums for education or medical benefits, which is another 3,000 a year. Then there's various lifestyle tax relief, which is 2,005. Breastfeeding equipment, childcare, setting funds aside for children's education fund in Scheme Simpanan Pendidikan Nasional. That's another 8,000 a year. Also domestic traveling, that's 1,000 a year. And there's additional lifestyle tax relief for additional 2,005. And there's also sports special tax relief of 500. So do look at what are the tax relief, and this tax relief may change from year to year. So always do keep updated on what's the various tax relief available for you and try to optimize that Now, this doesn't mean, spending unnecessarily just to maximize the tax benefit. But hey, if you are already paying for those, if you're already setting funds aside, or you have certain goals like saving for insurance, education, or putting funds aside for your own future retirement, using these vehicles while at the same time benefiting from the tax relief may be a wise move to take as well. Last but not least, most importantly, is really to take action today. Start by looking at your own financial plan. There's a wealth of available resources available to you. You can also get help from various government agencies in your countries as well. You can also get qualified and impartial professional advice, which holistically looks at your personal finances by talking to a licensed financial planner. So, when we look at retirement, what one really wants to look at is what is it at the end of the day? How would you picture it would be at your own funeral? So, how do you live a life that's purposeful, that's meaningful, and even during the time during your retirement till your final passing? All of this really matters. So, people are generally happier when there is a purpose when it comes to what you're doing. So, the first thing really is to find your why in what you're doing, who and what really matters to you in your life. And once you can identify that, then you can start crafting your retirement plan to head towards your ideal life that you want. Retirement planning, at the end of the day, it involves knowing how much money you need when you retire and how you will achieve that goal through saving, through investments. It's not built in a day, but through a period of time, through compounding. This is something that you can definitely achieve. So, really look at how can you simplify, how can you grow, how can you be confident, and let time work on your side to build wealth towards achieving your retirement goals. So if you need help, talk to a financial planner, talk to a financial coach. They'll help you to evaluate what are the various options out there, what are the solutions out there, to help you discuss about what are your goals, what matters to you, and tie it all together for you to come up with your own financial plan.